After reviewing more than 50 monthly and weekly income ETFs, in 2025, everything from covered calls to put-right strategies, one name keeps showing up at the top of every metric that actually matters: total return, risk-adjusted performance, and consistency through volatility. This ETF was launched in late 2023, and it's already crossed more than $2 billion in assets, and it's doing it without the hype, without the flashy marketing, and without the unrealistic yields you see plastered across social media. It's simply executing its strategy better than almost everyone else. And that's why so many are now calling it the most dependable income ETF of 2025. Today we're taking a closer look at the Goldman Sachs S&P 500 Premium Income ETF, ticker GPIX, and why this might be one of the strongest choices for retirees and for investors who simply want reliable cash flow without signing up for extreme volatility. GPIX is designed to track the general behavior of the S&P 500 while smoothing out the ride and layering in steady premium income on top. For anyone looking to keep their portfolio growing but still generate predictable payouts, this is the type of fund that deserves a serious look. GPIX is an actively managed exchange-traded fund launched by Goldman Sachs Asset Management on October 24, 2023. It seeks to provide current income while maintaining potential for capital appreciation, primarily by investing in large-cap U.S. equities from the S&P 500 index. What sets GPIX apart is its dynamic covered call options strategy. The fund holds a portfolio of S&P 500 stocks and sells out-of-the-money call options on 25 to 75% of its holdings, adjusted based on market volatility and momentum signals. This generates premium income for monthly distributions, offering a balance between yield and upside participation, without fully capping gains like more static covered call ETFs, especially those overriding 100% of the portfolio. GPIX is designed for income-focused investors who want S&P 500 exposure with enhanced yield in a volatile market. Its benchmark is the S&P 500 Total Return Index, and it has shown resilience with a 2025 year-to-date total return of approximately 13.89%. GPIX also keeps costs low. The fund charges a net expense ratio of 0.29%, which works out to about $29 a year for every $10,000 invested. For an actively managed, options-driven strategy, that's remarkably competitive. It's cheaper than a lot of the funds it competes with. GPI sits at 0.35%, SPY at 0.68%, yet GPIX is still giving you active management, weekly options execution, and disciplined rebalancing. In other words, you're getting a sophisticated hybrid strategy at a cost that undercuts most of the category. When we look at performance, GPIX has held its own impressively against other income-focused ETFs in its category. Year to date, GPIX has returned 12.95%, which matches SPY and trails slightly behind T-SPY at 13.64%. Over the past year, GPIX continues to show strength. GPIX has delivered exceptional returns, highlighting its ability to generate strong returns while maintaining a balanced, income-focused approach for investors. This performance demonstrates that the fund isn't just keeping pace with its peers, it's leading in most categories, making it a compelling option for investors seeking both growth and premium income, with little drawdowns during market corrections. The fund currently pays a distribution yield of around 8% annually, which might seem modest compared to some high-income ETFs that advertise sky-high yields, sometimes 50 to 100% annualized. Investors chasing high yield might overlook this fund because of this lower yield. However, that's actually a strength. A more moderate yield helps preserve capital stability and long-term growth, rather than forcing the fund to take excessive risks to generate outsized distributions that are usually not sustainable long-term. High-yield ETFs often achieve their returns through aggressive options, strategies, or heavy leverage, which can lead to price erosion and NAV shocks during market swings. By keeping its distribution yield sustainable, the Goldman Sachs S&P 500 Premium Income ETF balances steady income with the potential for capital appreciation, making it a safer, more predictable option for investors who want income without exposing themselves to the roller coaster risks that come with ultra-aggressive strategies. Investors need to realize that as much as those 50 to 100% distribution yields sound exciting on paper, mathematically, they're almost impossible to sustain. And the reason is simple: Every option income ETF, no matter how it's packaged or marketed, is bound by the same math of implied volatility. Option income only comes from one thing: selling volatility. Covered calls, cash secured puts, wheel strategies, 0DTE spreads, they all rely on the market's IV to decide how much premium you collect, and implied volatility has natural limits. One research showed that on the S&P 500, typically 12 to 25% IV translates to roughly 9 to 18% maximum annualized premium from selling monthly at the money options. On the Nasdaq 100, 18 to 35% IV is around 15 to 28% max annualized premium. For high volatility stocks like Tesla or Coinbase, you are looking at 50 to 120% IV, which in extreme cases translate to 35 to 60% annualized premium. And on Bitcoin, a 50 to 80% IV translates to about 35 to 55% annualized premium. And that's the upper limit, theoretical max, assuming you're selling perfectly timed, perfectly sized at the money options every single month with no losses, no assignment issues, and no market chop. Even in the worst market meltdowns we've ever seen, whether it was the 2008 financial crisis or the March 2020 crash, implied volatility never stayed high enough, long enough, to produce a true 50% annual yield, let alone anything close to 100% year after year. That's why most funds chasing 50 to 100% payouts almost always end up paying those yields by eroding something else. They're not unlocking a hidden income engine. They're just borrowing from your own capital and handing it back to you with a fancy label. The reality is this: for broad market option income funds, the absolute ceiling is typically the low to mid-teens. Anything consistently above 20% has either blown up in spectacular fashion or quietly handed investors back their own capital while calling it yield. So when you see a fund paying 50, 70, even 100% distributions, it's not because they've discovered a magical new income engine. It's because they're doing one or several of the following. They give you your own money back and label it income. But behind the scenes, your NAV is shrinking month after month, taking on risks that only show up when volatility explodes. And we've already seen the consequences. Look at the YieldMax ETFs. These were marketed with 60 to 120% yields. Fast forward to today, and many of them are down huge from their peaks. You can't escape the math. High yields that break the rules of volatility always end the same way, with capital erosion. Take any fund that promises a 60% yield. Now ask a simple question. If I invest $100,000, where exactly is the $60,000 per year coming from? Because when you break it down, the honest answers are never pretty, and they almost never come from actual, repeatable option income. Here's the realistic ceiling for 2025, based on how much premium the options market can mathematically generate. If your fund is in the 6 to 9% range, that's the sweet spot. Solid, sustainable, moderate risk. Move up to the 9 to 13% group, and the income is higher, but so is the volatility. Still workable, just bumpier. Once you enter that 14 to 25% territory, you're dealing with high implied volatility or concentrated single stock strategies. The payouts look great, but the risk is cranked way up. Anytime you see a fund paying 30%, 50%, or even 100% in yield, that's your cue to slow down and look under the hood. At those levels, you have to ask what the fund is really investing in and whether that payout is genuine income or just your own capital being recycled back to you, because based on the math, generating 50 to 100% annually from option premiums alone simply isn't sustainable. It's not how volatility works, and no options market in history has ever supported that kind of long-term income without blowing up the underlying capital. GPIX proves something most income investors still overlook. You don't need sky-high yields to build real, lasting wealth. What you need is a fund that respects math, protects your capital, and delivers steady income without blowing up your future. Between its disciplined premium selling strategy, its ability to track the S&P 500 with far less drama, and its realistic mid-single-digit to high single-digit yield range, GPIX stands out as one of the rare income ETFs built for longevity. It's the kind of fund retirees appreciate because the cash flow is dependable, and it's also the kind of fund long-term investors appreciate because the total return actually keeps up with the market instead of bleeding NAV to hit marketing-friendly distribution numbers. If you want an income ETF that trades hype for discipline volatility for stability, and extreme yields for real, sustainable math, GPIX is the one everyone should at least be paying attention to in 2025. If you found value in this breakdown, or if any part of this video helped you understand income ETFs a little better, make sure you hit that like button, subscribe, and tap that notification bell so you don't miss the next deep dive. Thanks for watching, and I'll see you in the next one.